The classic casino chip shuffle, placement stage. Imagine you've got a suitcase full of unexplained cash and you need to make it look legitimate. So you stroll into a casino like you're James Bond, except instead of saving the world, you're about to commit a felony. This is the casino chip shuffle, the OG method of turning dirty money into clean money with a receipt. Here's how it works. You walk into a casino with $100,000 in cash that came from selling illegal substances, running illegal gambling operations, or other criminal enterprises. You exchange this cash for casino chips, which is completely normal because casinos handle massive cash transactions every single day. Now comes the performance part. You need to actually gamble a little to make it look legitimate. You sit at a blackjack table, play some poker, maybe hit the roulette wheel. You're not trying to win big. You're trying to create the appearance of normal gambling activity. You might even intentionally lose 10 to 15% of your money to make it look more realistic. After a few hours of gambling, you cash out your chips for a check or wire transfer. Suddenly, your unexplained criminal proceeds have become documented casino winnings. The casino provides official records showing you gambled and won money, creating a paper trail that explains where your cash came from. The beauty of this method is that casinos are designed for high-volume cash transactions. Someone walking into a bank with $50,000 in cash triggers automatic reporting requirements and suspicious activity monitoring. But someone walking into a casino with $50,000 is just another Tuesday night high roller. Some sophisticated launderers don't even gamble much. They buy chips, walk around the casino for a few hours, maybe play some low-stakes slot machines, then cash out most of their original amount. The casino's surveillance and transaction records show gambling activity, but they've essentially just paid a small fee to get official documentation for their money. Modern casinos have caught on to this scheme and now have sophisticated anti-money laundering programs. They monitor for customers who exchange large amounts of cash for chips but don't actually gamble much. They're required to file suspicious activity reports for unusual patterns. But back in the day, this was like having a money cleaning service with a neon sign. Smurfing, the ant colony approach. Smurfing gets its name from the little blue cartoon characters because it involves using lots of small actors to accomplish a big task. Instead of making one giant suspicious transaction, you break dirty money into thousands of tiny transactions that individually look completely normal. Banks are legally required to report any cash transaction over $10,000 to the Financial Crimes Enforcement Network. So Smurfs, the people making these small deposits, carefully stay under that threshold. They might deposit $9,500 at Bank of America, $8,000 at Wells Fargo, $7,200 at Chase, and $6,800 at a local credit union. But here's where it gets sophisticated. Good smurfing operations don't just randomly pick amounts under $10,000. They study normal banking patterns and mimic them. They deposit amounts like $3,247 or $5,891, numbers that look like legitimate business deposits or paycheck amounts, not round numbers that might trigger suspicion. The coordination required is like running a nationwide logistics operation. You need to recruit dozens or hundreds of people to make deposits across different banks, different cities, even different states. Each Smurf might visit multiple banks in a single day, making deposits at different times to avoid patterns. Many Smurfs don't even know they're part of a money laundering operation. They might think they're helping someone who doesn't have time to make deposits themselves, or they're told it's for tax planning purposes. Some are paid small amounts, maybe $100 per deposit, making it attractive to people who need quick cash. The operation requires careful record keeping to track which deposits were made where and when. Successful smurfing rings have moved hundreds of millions of dollars by making tens of thousands of small deposits that individually appeared completely legitimate. But modern banking surveillance uses artificial intelligence to detect smurfing patterns. The software looks for multiple small deposits just under reporting thresholds, deposits made by the same person at different banks, or deposits that follow suspicious timing patterns. When the AI flags potential smurfing activity, human investigators review the patterns and file suspicious activity reports. Integration through business ownership, the Laundromat method. This is literally where the term money laundering comes from, using legitimate businesses like actual laundromats to wash dirty money until it comes out clean. The genius of this method is that you're not hiding money. You're hiding it in plain sight by mixing it with legitimate business revenue. Cash-intensive businesses are perfect for this because they naturally handle lots of small bills and don't rely heavily on credit card transactions. Laundromats, car washes, restaurants, convenience stores, beauty salons, and parking lots all fit this profile. These businesses provide perfect cover for unexplained cash. Here's how it works. You buy a legitimate pizza restaurant with some of your dirty money. The restaurant actually operates normally. It serves real pizza to real customers and generates legitimate revenue. But you also report fake sales to explain additional cash deposits. Let's say your restaurant actually sells $5,000 worth of pizza on Tuesday, but you report $8,000 in sales. You take $3,000 of your dirty money and deposit it with your legitimate revenue, paying taxes on the fake $3,000 in sales. Now that dirty money has become taxed business income with proper documentation. The key is maintaining realistic ratios. If your restaurant can realistically serve 200 customers per day, you can't claim to have served 500 customers without raising suspicion. You need to inflate sales numbers gradually and believably, maybe claiming 250 customers instead of 200. Some operations run multiple complementary businesses to create an entire ecosystem of cross-referencing revenue streams. The laundromat refers customers to the restaurant. The restaurant caters events at the car wash. The car wash recommends the beauty salon. Everything looks interconnected and legitimate while serving as channels for money laundering. The challenge is that you actually have to run real businesses while using them to launder money. You need real employees, real customers, real inventory, real business licenses, and real health department inspections. You're essentially playing house while committing financial crimes, which requires genuine business management skills. Modern investigations look for businesses with unusual cash patterns, restaurants that report much higher per-customer spending than industry averages, laundromats in small towns that somehow generate massive revenue, or car washes that claim to be busier than McDonald's despite having empty parking lots. Layering through international wire transfers, the global shell game. Layering is the stage where dirty money gets passed through so many transactions across so many jurisdictions that tracing its original source becomes practically impossible. It's like playing three-card Monte with bank accounts, except the cards are spread across 50 different countries. The money starts in country A and gets wired to a bank account in country B. From there, it moves to an investment account in country C, then to a cryptocurrency exchange in country D, then to a shell company account in country E. Each transfer creates a new paper trail while burying the previous ones under layers of international bureaucracy. Shell companies are crucial for layering because they exist solely on paper, but can legally send and receive money. You might create Panama Marketing Solutions, which sends money to Singapore Tech Ventures, which invests in Swiss Alpine Holdings, which deposits money in Luxembourg Financial Services. Each company exists only to move money and create legal complexity. The beauty of international layering is that each country has different banking laws, different reporting requirements, and different levels of cooperation with international law enforcement. Money can move instantly across borders, but investigations require formal requests through diplomatic channels that can take months or years. Cryptocurrency has revolutionized layering because digital currencies can move across borders instantly without traditional banking oversight. Money can hop through multiple crypto exchanges, get converted between different digital currencies, pass through privacy coins like Monero, and emerge in different jurisdictions as apparently legitimate cryptocurrency trading profits. Some layering operations create circular ownership structures where Company A owns Company B, which owns Company C, which owns Company A. This creates ownership loops that make it legally impossible to determine who actually controls the money. Investigators end up chasing their own tails through corporate registrations that lead nowhere. By the time money has moved through 15 different accounts in 8 different countries, each governed by different laws and requiring different types of international cooperation to investigate, most law enforcement agencies simply don't have the resources to trace the complete path. Trade-based laundering, the invoice shuffle. Trade-based money laundering is the most sophisticated method because it hides financial crimes inside legitimate international commerce. Instead of moving money directly, criminals manipulate trade invoices and shipments to transfer value while appearing to conduct normal import-export business. Over-invoicing is the classic technique. Company A in Mexico claims to buy $1 million worth of t-shirts from Company B in China, but the t-shirts are actually worth only $100,000. The extra $900,000 is dirty money being moved internationally disguised as payment for overpriced merchandise. Under-invoicing works in reverse. You export $1 million worth of electronics but only invoice the buyer for $100,000. The buyer pays the invoiced amount through official channels, then pays the remaining $900,000 through unofficial channels, effectively moving money outside the formal banking system. Multiple invoicing involves selling the same goods to multiple buyers, or billing the same buyer multiple times for shipments that were only delivered once. It's like selling the same car to 5 different people while only delivering one car, except instead of cars, you're using shipping containers full of widgets. Phantom shipments take this further, invoicing for goods that don't exist at all. Company A claims to buy $2 million worth of consulting services from Company B, but no services are actually provided. The payment is just money movement disguised as international trade. The genius of trade-based laundering is that international commerce is so complex and voluminous that fake transactions blend seamlessly with legitimate trade. Customs officials can't physically inspect every shipment or verify the actual value of every invoice. They rely on documentation that criminals can easily falsify. Some operations use legitimate businesses as unwitting accomplices. A real importing company might receive slightly overpriced goods without realizing they're participating in money laundering. They think they're just paying market rates for products, not knowing that part of their payment is cleaning someone else's criminal proceeds. Hawala networks often facilitate trade-based laundering by providing unofficial money transfer services that operate parallel to formal banking systems. These networks can move money across borders through trade transactions without any actual money crossing borders, just offsetting debts between Hawala brokers in different countries. Real estate washing, property value manipulation. Real estate is perfect for money laundering because property values are subjective. Transactions involve naturally large amounts of money, and ownership can be hidden through complex corporate structures. You can buy property with dirty money, then sell it for clean money with completely legitimate documentation. The basic approach involves purchasing property below market value with cash, making cosmetic improvements, then selling at or above market value. A $200,000 house bought with drug money, renovated for $50,000, and sold for $300,000 produces $50,000 in apparently legitimate real estate investment profits. But sophisticated real estate laundering goes much deeper. Criminals create networks of shell companies that buy and sell properties to each other at inflated prices, each transaction creating documentation that justifies higher property values and cleaner money. Straw buyers are crucial. These are people who purchase property on behalf of the real owner to hide the actual source of funds. The straw buyer's name appears on all official paperwork, while the criminal maintains actual control through side agreements. Some straw buyers don't even know they're fronting for criminals. International luxury real estate markets are especially useful because properties in places like London, New York, Miami, or Dubai can absorb millions of dollars in single transactions. Many jurisdictions allow anonymous purchases through shell companies, making it nearly impossible to identify the true beneficial owners. Some operations flip properties rapidly between related entities to justify massive price increases. A property might sell for $1 million, then sell again 6 months later for $2 million, then sell again for $3 million, each time to different shell companies controlled by the same criminal organization. Construction projects provide additional opportunities because building costs are difficult to verify and materials can be overpriced to justify additional cash flow. A criminal might claim to spend $5 million building a house that actually costs $2 million, using the extra $3 million to launder dirty money through construction expenses. The Panama Papers revealed how widespread real estate laundering has become, with thousands of luxury properties worldwide owned by anonymous shell companies that exist solely to hide criminal proceeds. Some entire city blocks in major financial centers are effectively owned by criminal organizations through these structures. Shell companies and offshore accounts. The Matryoshka doll system. Shell companies are like Russian nesting dolls. Each company owns another company, which owns another company, creating layers of ownership so complex that finding the real beneficial owner becomes nearly impossible. These structures are legal when used properly, but criminals exploit them to hide money and ownership. A typical laundering structure might involve 7 layers. Company A in the Cayman Islands owns Company B in Panama, which owns Company C in Switzerland, which owns Company D in Singapore, which owns Company E in Luxembourg, which owns Company F in Dubai, which finally owns the bank account holding the laundered money. Each layer adds legal complexity and jurisdictional barriers. Investigating Company F requires cooperation from Dubai authorities. Investigating Company E requires cooperation from Luxembourg authorities. By the time investigators work through all 7 layers, they need cooperation from 7 different countries, each with different laws and different levels of willingness to assist foreign investigations. These shell companies often have legitimate-sounding names and minimal business activity, just enough to maintain legal existence while serving as money-moving vehicles. Global financial solutions, international trade partners, strategic investment holdings. Names that sound professional, but reveal nothing about actual business activities. Some structures create circular ownership where companies own each other in loops that make ultimate ownership determination mathematically impossible. Company A owns Company B, which owns Company C, which owns Company A. Who really controls the money? Even sophisticated forensic accounting can't answer that question. Offshore banking havens facilitate these structures by offering strict banking secrecy laws, minimal reporting requirements, and legal frameworks specifically designed to hide beneficial ownership. Money can sit in these accounts indefinitely, while appearing completely legitimate to any casual inquiry. The most sophisticated operations change ownership structures regularly, transferring assets between different shell companies in different jurisdictions to stay ahead of any potential investigations. By the time law enforcement gets cooperation from one country, the money has already moved to a completely different structure in completely different countries. Digital currency laundering, the blockchain shuffle. Cryptocurrency has created entirely new methods for money laundering that didn't exist before digital currencies. While blockchain transactions are theoretically traceable, the pseudonymous nature of crypto addresses and the global nature of digital currency markets make tracing extremely difficult in practice. The basic approach involves converting dirty fiat money into cryptocurrency, then moving it through multiple digital currency exchanges and wallet addresses to obscure the trail. Each transaction creates a new blockchain record, but these records only show wallet addresses, not the real-world identities behind them. Privacy coins like Monero, Zcash, and Dash are specifically designed to hide transaction details, making them popular for laundering operations. Money can enter the crypto ecosystem through Bitcoin, get converted to Monero to hide the trail, then converted back to Bitcoin or other currencies to exit the system. Crypto mixing services, also called tumblers, take this further by pooling together cryptocurrency from multiple users and redistributing it to different addresses, making it nearly impossible to trace which input corresponds to which output. It's like putting all the money in a giant digital blender. Decentralized exchanges operate without traditional know-your-customer requirements, allowing users to trade cryptocurrencies without providing identification. Money can move between different digital currencies without creating traditional financial records that link transactions to real people. Some criminals use crypto arbitrage as a laundering method, buying cryptocurrency on one exchange and immediately selling it on another exchange for a small loss. The loss is effectively a laundering fee, and the money emerges with documentation showing legitimate cryptocurrency trading activity. NFTs, non-fungible tokens, have created new laundering opportunities because they can be bought and sold for arbitrary amounts. A criminal can create an NFT, sell it to themselves through a shell company for $1 million, and claim the proceeds are legitimate art sales. Bank complicity and offshore banking, the inside game. Sometimes money laundering succeeds because financial institutions either look the other way or actively participate in criminal schemes. Corrupt bank employees can disable monitoring systems, ignore suspicious activity reports, or create fake accounts, specifically for laundering operations. Some offshore banks built their entire business models around attracting money that doesn't want to be tracked. They offer services like numbered accounts, bearer bonds, minimal documentation requirements, and explicit policies of not cooperating with foreign law enforcement investigations. The correspondent banking system allows smaller banks to access international payment networks through larger banks. Corrupt institutions can exploit these relationships to move dirty money through legitimate banking channels, while the correspondent bank maintains plausible deniability about the ultimate source of funds. Some banks develop relationships with money service businesses that specialize in moving questionable funds. These partnerships allow banks to profit from laundering activity through intermediaries while maintaining distance from direct criminal involvement. Regulatory capture occurs in some jurisdictions where banks become so important to local economies that regulators avoid enforcing anti-money laundering laws too strictly. Some countries depend heavily on financial services revenue and don't ask too many questions about where the money comes from. The FinCEN files revealed that major international banks processed over $2 trillion in potentially suspicious transactions while knowing the money might be linked to criminal activity. Some banks treated suspicious activity reports as mere paperwork requirements rather than genuine efforts to prevent money laundering. Hawala and alternative remittance systems, the invisible network. Hawala is an ancient money transfer system that operates completely outside formal banking networks, making it nearly impossible for law enforcement to trace transactions. The system is based on trust relationships between Hawala brokers who settle debts through offsetting transactions rather than actual money movement. Here's how it works. Criminal A in New York gives $100,000 to Hawala broker X. Broker X contacts broker Y in Pakistan, who gives $100,000 minus fees to criminal B. No money actually crosses borders. The brokers just owe each other $100,000, which they'll settle later through legitimate trade transactions or future Hawala transfers in the opposite direction. The beauty of Hawala for criminals is that there are no formal records, no bank accounts, no wire transfers, and no paper trail that law enforcement can follow. The only evidence is verbal agreements between brokers who often never meet face-to-face and communicate only through coded phone calls. Some Hawala networks are massive, handling billions of dollars annually through networks of brokers in dozens of countries. They're faster than traditional banking, charge lower fees than wire transfers, and operate 24/7 without banking hours or weekend restrictions. Trade-based Hawala combines money transfer with invoice manipulation. A Hawala broker in country A might export goods to country B at below market prices, with the price difference representing Hawala transfers. The importer in country B gets goods worth $1 million for $700,000, effectively receiving a $300,000 Hawala transfer. Modern variations use digital communication and cryptocurrency to enhance traditional Hawala systems. Brokers coordinate transactions through encrypted messaging apps and settle debts using digital currencies that can move across borders instantly. Professional money laundering organizations, the service industry. Modern money laundering has evolved into a professional service industry where specialists offer laundering services to criminal organizations for fees, just like legitimate businesses hire accounting firms or law firms for specialized services. Professional money launderers often have legitimate business backgrounds in banking, accounting, law, or international trade. They use their expertise and professional networks to move money more efficiently than criminal organizations could manage on their own. These organizations offer full-service packages. They'll take dirty money, move it through their established networks, and return it as apparently legitimate funds for fees ranging from 8% to 20% of the laundered amount. It's like hiring a dry cleaner, except for money instead of clothes. Some professional launderers specialize in specific methods: real estate specialists, trade-based laundering experts, or cryptocurrency specialists. Criminal organizations can shop around for the best services just like legitimate businesses compare vendors. The most sophisticated professional laundering organizations maintain legitimate business fronts and employ people who don't know they're working for criminal enterprises. A seemingly legitimate import-export company might actually be a front for trade-based money laundering operations. These organizations often launder money for multiple criminal groups simultaneously. creating economies of scale that make their services more efficient and harder to detect than individual laundering operations. The conclusion: financial crime prevention and detection. Understanding these money laundering tactics isn't about enabling criminal activity. It's about recognizing how financial crimes work so they can be prevented and detected. Every method described here has been used by actual criminals, but also studied extensively by law enforcement, financial institutions, and regulatory agencies developing countermeasures. Modern anti-money laundering systems use artificial intelligence and machine learning to detect suspicious patterns that humans might miss. These systems can analyze millions of transactions simultaneously, looking for patterns consistent with known laundering methods. International cooperation has improved dramatically, with organizations like the Financial Action Task Force setting global standards for anti-money laundering efforts. Information sharing between countries and financial institutions makes it much harder for criminals to exploit jurisdictional gaps. The most important takeaway is that successful money laundering requires extensive planning, multiple accomplices, sophisticated knowledge of financial systems, and significant resources to execute. It's not something individuals can easily accomplish. It typically involves organized criminal enterprises with professional expertise. Banks and other financial institutions invest billions of dollars annually in compliance systems designed to detect and prevent money laundering. They're required to file suspicious activity reports, verify customer identities, and monitor transactions for unusual patterns. But criminals constantly evolve their methods as detection systems improve. New technologies create new opportunities for both money laundering and money laundering detection. It's an ongoing arms race between criminal innovation and law enforcement response. If you encounter suspicious financial activity in your professional or personal life, reporting it to appropriate authorities helps protect the integrity of the financial system that everyone depends on. Financial crimes ultimately harm everyone by increasing costs, reducing trust, and enabling other criminal activities. Knowledge about these crimes should be used to prevent them, not enable them. The goal of understanding money laundering tactics is to make them less effective by increasing awareness among legitimate businesses, financial professionals, and the general public about how to recognize and report suspicious activity.